Okay, we're looking at what has to be one of the most confusing contradictions in modern economic history. Because right now, on paper at least, America is richer than it has ever been. We're talking record stock prices, rising home values, household wealth hitting historic all-time peaks. But if you look just beneath those headlines, there is a completely different reality playing out. For millions of Americans, this supposed boom, well, it actually feels a lot like financial suffocation. So in this explainer, we're going to unpack exactly why the official macroeconomic data looks so incredibly good, while everyday life feels so heavy for so many people.
At the center of all this is a core mystery. If the economy is doing so well, why do we feel so broke? Think about this for a second. The stock market recently hit its 23rd record high of the year. 23. Yet at the exact same time, consumer sentiment toward the economy fell to its lowest level ever recorded. People are literally feeling worse about their financial reality today than they did during the 2008 global financial crisis, worse than during the pandemic lockdowns, and worse than the recessions of the early 1980s. The data is telling us we're booming, but the people are saying they're drowning.
This divide effectively splits the nation into two distinct realities. On one side, we have the headline economy. This is exactly what you see on the evening news. Record stock highs, rising home prices, peak net worth. And if you stop right there, you'd think everything is perfect. But then, on the other side, you have the lived economy. This is the day-to-day reality characterized by record low sentiment, shrinking savings, and frankly, a terrifying rise in people pulling money out of their retirement accounts just to survive. Both of these economies are absolutely real, but they are happening to completely different groups of people.
The sheer scale of this desperation is hiding in plain sight. Despite average 401k balances hitting record highs, the rate of people taking early hardship withdrawals from those exact same accounts has tripled. 3 times. I really want you to pause and think about what that actually means. A retirement account is the money you are never supposed to touch, yet people are willingly paying massive penalties to cash them out early. And they aren't doing it to buy boats or go on vacation. 36% of those withdrawals were specifically to avoid eviction or foreclosure, and 31% were just to cover medical bills. People are literally liquidating their future just to survive today. Let's move into section 1. Follow the money. Who owns the gains? To really understand how this is happening, we have to change the question we're asking. The real question is no longer, is America richer? It's who exactly is getting richer. We need to follow the money and see exactly where all these economic gains are actually landing. Because when the stock market climbs, trillions of dollars are created. But that money doesn't just fall on the country evenly like rain. It lands in very specific accounts. According to Federal Reserve data, the wealthiest 10% of households in America own roughly 87% of all the stocks in the country. That leaves the bottom 90%, which is about 120 million households, holding just 13%. So, when the market prints a brand new record high, the overwhelming majority of those trillions flow directly into the accounts of a very small, already wealthy slice of the population.
But the further down you go, the more striking this divide becomes. Let's look at the bottom half of the country. We're talking about 67 million households here. The teachers, the nurses, the bus drivers, the people who literally run the day-to-day operations of this country. Together, they own just 1% of the entire stock market. And that's not 1% each. That is 1% total, split among 67 million households. So when you hear the narrative that the stock market is democratized because everyone owns some stock, you really have to realize that owning some stock and owning enough for it to actually change your life are two entirely different things.
Putting actual dollar figures to this illusion reveals a pretty stark contrast. Let's say the market returns 16% in a given year. For the bottom half of the country, whose median stock holdings sit around $13,000, that 16% return is a paper gain of about $2,000. Now that's nice, but it certainly doesn't change your life. But for the top 10%, who hold massive equity, that exact same 16% return hands them over $96,000 in paper gains. The participation might be democratized, but the actual dollars never work.
All right, section 2, the cost of living squeeze. So the people at the top are capturing all the asset gains. But what is happening to everyone else? Leaving Wall Street behind for a second, we have to look at Main Street's paycheck to bills pipeline. Because, let's face it, that is where the vast majority of Americans actually live. We constantly hear the news telling us that wages are going up, and technically that is true. But what matters isn't the size of your paycheck, it's whether your paycheck grew faster than your life got more expensive. Recently, average hourly earnings were up about 3.6%. That sounds great, until you realize that over that exact same stretch, inflation was up 3.8%. Before the average worker can spend a single dollar of their hard-earned raise, it has already been entirely eaten by the rising cost of living.
And this brings us to a massive, fundamental misunderstanding about inflation. Since the start of 2020, cumulative prices are up over 28%. So when the news tells you that inflation is cooling, they are not saying prices are going back down. They're just saying that prices are still incredibly high, but they are rising a little more slowly now. If your rent, your groceries, and your car insurance jumped up massively and stayed there, the damage doesn't just magically vanish because the inflation rate on TV ticked lower. That new, heavy cost structure has simply become your permanent reality.
Which takes us to Section 3, the illusion, uncovering the hidden engine.
All of this leads us to a very natural question. If wages are being eaten by inflation and regular people are this squeezed, why does consumer spending still look so strong? Why hasn't the whole economy completely stalled out by now? Well, we have to uncover the hidden engine driving that spending. And the answer? It's coming from the future. It's coming from debt. Americans are currently carrying an absolutely terrifying $1.25 trillion in credit card debt alone. And remember, the average interest rate on these cards is hovering around 23%. This spending isn't a sign of a strong, healthy consumer. It's a sign of a consumer leaning on extremely expensive revolving credit just to keep the lights on and the fridge stocked. We actually have a grim new term for this exact phenomenon: survival debt. This isn't someone financing a vacation to Europe to rack up airline points. This is debt being used to bridge the gap for basic everyday necessities, groceries, rent, utility bills, because the math between wages and expenses simply no longer works. When a third of consumers carrying balances openly say that day-to-day expenses are the primary source of their debt, you are looking at a population that is financing its basic existence.
And the experts are seriously sounding the alarm here. Mike Croxson, who runs the largest nonprofit credit counseling network in the country, explicitly called out this disturbing shift from discretionary debt to survival debt. And the most dangerous thing about survival debt is that there is rarely a clear way out. You aren't paying it off next month because next month's bills are going to be just as high. That is exactly why 61% of people with credit card debt have now been trapped in that vicious cycle for over a year. But it doesn't even stop at credit cards. Look at the absolute explosion of buy now, pay later services. This used to be a tool for buying a couch or maybe a new laptop. Now, over 90 million Americans use it. And shockingly, more than a quarter of them are using it just to buy groceries. Over half say they literally couldn't make ends meet without it. When families are forced to slice a routine trip to the grocery store into 4 separate installment payments, that is not a budgeting hack. That is a giant red flag that household cash flow is entirely broken.
So what happens when a family living on the edge finally hits a real emergency? They used to rely on savings, but the personal savings rate has plummeted to just 2.6%. And here is the truly chilling statistic. For the bottom 50% of Americans, the monthly savings rate is actually negative, meaning they are spending more than they bring in after taxes every single month. They aren't just missing a safety net. They are actively sinking deeper and deeper underwater with every passing week.
Section 4. The E-shaped economy. For years, economists called this a K-shaped recovery. You know, the rich pulling up, the poor falling down. But we need a new framework to truly understand what's happening today, because the reality of the American economy is no longer K-shaped. It is E-shaped. Just imagine the letter E, 3 horizontal bars representing 3 completely distinct Americans living under one flag right now. The top bar is the ownership class, that top 10%, whose wealth lives in stocks and real estate. As assets inflate, this bar stretches way, way out ahead. The bottom bar is the bottom half of the country, basically stuck on the floor, relying on survival debt just to function. And then you have that middle bar, the squeezed middle. This is the traditional middle class, but their bar is sloping steadily downward as their wages are entirely eaten by structural costs. And you can actually see that middle bar slipping in real-time consumer behavior. Heather Long from Navy Federal Credit Union noted a very pronounced migration away from premium grocers, like your Whole Foods, toward discount and warehouse stores like Aldi and Walmart. This isn't poverty, but it is extreme pressure. This is a massive class of Americans who still have a foothold, sure, but they can feel that thin layer of breathing room getting thinner by the day. They are quietly trading down just to maintain their footing.
The absolute crucial point here is summarized perfectly by the brutal math of this divide. The top 10% commands 68% of the total net worth and over half the income. The middle 40% holds on to 29% of the wealth. And the bottom 50%, literally half of the entire population, is left fighting over just 2.5% of the nation's net worth. So when you hear those glowing headlines about a booming economy, remember, you are looking at aggregate data that is overwhelmingly being driven by and benefiting that very top tier.
Which leaves us with this final lingering thought. The very next time you see a headline celebrating record wealth or resilient consumer spending, I want you to ask yourself, who actually captured those gains and who simply got stuck financing their own survival? Because until we recognize that we have multiple economies living inside one single country, the huge disconnect between the glowing news reports and our shrinking bank accounts is only going to get wider. So what do you think? Are we heading for a soft landing or just a slow, inevitable squeeze? Keep questioning those headlines, and I'll see you in the next explainer.